Hello, welcome back to Economica and Happy New Year. I hope you're all well, drunk, enjoying 2025 with lots of fun with your loved ones, your family, your friends, and you're having a good time because we are off a good start this year. And after a very good 2023 and 2024 for stock market, for those of you that invest, and we saw that the S&P in 24 was up 24%, the Nasdaq 100 was up 27%, and the Dow 12%, the Russell 2000 10%, and also in 2023 we had plus 20% gains for the broader indices, and after 2 years in a row and stratospheric returns since after Q1 2020, so for 4 years in a row we have been having stellar returns in stock market. And is it the time to basically take a pause and profit from these historical very high gains, like of 90% return on indices, 150% return? And yes, I will bring you with me today, and there is a lot of stuff, a lot of material, and I have completed actually what probably could be eventually a working paper that I will upload somewhere on the internet, on some academic websites. So I have a lot of stuff, and I'm very excited, and I think that I could basically conclude the video within the next few seconds, because if I click here and forecast, we see that this very reputable website gives us a forecast of more or less 400 points decline forecast for the S&P 500. So this is a website is called Trading Economics, and it's a very reputable website, and yeah, this is a normal thing, and we see that the forecast from this website is a decline on the S&P 500 in the next quarters. And we are coming off the month of December, which has been negative, -5, -8%, and which are large drawdowns on a monthly basis for the Dow Jones and the Russell 2000, smaller declines for the S&P, -2.7%, and only 0.5% the Nasdaq 100, and the VIX, the Volatility Index, was up 4%. So let's start with this, and yeah, basically oh dear, yeah, start from here. And yes, I gathered a bunch of data. I took the Dow Jones, the Nasdaq 100, the S&P 500, and the Russell 3000, not the Russell 2000, the Russell 2000 indices, and I pulled together a discrete time series that goes from 2007 to 2024. So we captured also the 2008 GFC and 2011, 2012, and then the volatility of 2020. And first thing first, I just went for the analyzed historical volatility that is based on the 7 days and 21 days rolling average of the volatility. And yeah, I should have the data somewhere. Allow me a second, or maybe I should switch. Yeah, let's switch with this. Okay, so we will go on the on the whole Jupyter code, and yes, we can see that the vol, yeah, so the annualized 7-day rolling average vol, it's 14.8% for the Dow, let's say 16% for the S&P 500, 19% for the Nasdaq 100, and 16.2% for the Russell 3000. I want to remind you all, for those who are not aware of this, the Russell 3000, it's a benchmark with 3,000 companies, and it's a very accurate and important benchmark and proxy for the whole stock market. The same as the S&P 500. Those are the two among the more accurate benchmark indices that hold the most important listed companies. So the Russell 3000 has 3,000 stocks, and it's very broadly representative of the whole market, or a good chunk of the market. So the data, it's poignant to this level. And what we are trying to do, basically, what I've been working on, is that we have seen that in the past periods, like in the past month, we have seen some declines for the broader stock market in the indices, like the Dow or the S&P. They were down 5% or 2%, and these volatility patterns, they could be a market sign, a market signal for what is the well-known Q1 seasonal market correction. So I tried to pinpoint and to cluster down and find exactly what are the data points that can lead me to the conclusion, to the empirical conclusion, that in Q1 the stock market, the broader indices, they could have a normal seasonal drawdown. And I tried to measure how large can be the drawdown, and on the basis of the standard, the annualized volatility, on the basis of the GARCH and EGARCH conditional volatility, and then I applied some other methods of stochastic volatility, the seasonal decomposition of volatility that has been worked with the VIX, the volatility index, and the CBOE, the Chicago Board of Exchange volatility index. So there is a wealth of data that has been worked through the normal stock market thing that everybody sees, and yeah, I will make you the case for why it's very likely that we can have a seasonal correction in Q1, in the first 3 months of 2025. It's by no means a certainty or an absolute truth, but is it possible? Is it possible? We will see. So going further, then I went through the code, and here we have charts for, we can see the VAR. So all these dots, they are the clustering of the VAR 95, VAR 97.5, VAR 99, VAR 99.9 violations. So for the whole time series, let me pull down the music. So for the whole time series from 2007 up to December 2024, here we have the dots, the blue dots, the orange dot, the green dot, and the red dot. They are for the respective VAR levels. and we see that we can see here that in the latter part of 2024 we have seen a exogenous extreme fat tail market volatility with VAR 99 and VAR 99.9 days, single days, 1 day fat tail extreme loss in the market, and these have been realized in Q4. So when you have these outsized market moves, which are then clustered with also with VAR 95 or 97, then you can start to build up some volatility, and then volatility gains momentum, and then we can see that going from Q4 into Q1, this volatility momentum then takes shapes with instead of having a 1 day very large drawdown, it can be a week or a month or a couple of months or a few weeks, so that the market adjusts the stock prices valuation. It's just a mechanical thing that happens, and then investors basically decide on the basis of supply and demand what is the price of a determinate stock or the indices. So these are normal, this is the market. It's basically price discovery and the supply based on supply and demand. So if asset managers they decide that they want to sell and they can't be stopped, they want to sell because they think that stock prices, they are overvalued and there is too much uncertainty going forward, so they decide to sell, and then they want to see the price adjusted down to more acceptable or reasonable levels, so that the stock price it's more proportionate to the market risk or the systemic risk that exposure to equities brings within it. So then I managed to summarize what how many VAR days have been accumulated in between 2007 and 2024, and here we have the VAR 95, the Dow is at 2285, VAR 95 in spread across 18 years or 17 years from 2007 to 2024. So the Dow 285, S&P 281, 295, 284 for the Nasdaq and the Russell 3000, and then we see 97.5. You can read it by yourself. 175, 177, and then it narrows down. VAR 99, we have 89 days for the Dow, spread across 2007 to up to 2024, 102 days for the S&P, 88 days for the Nasdaq 100, and 100 days for the Russell 3000. And the VAR 99.9, it's more or less the same amount of days, because these are very large one-day drawdowns, so there is a very high correlation between the whole bunch of indices in the stock market. So both the Dow and the S&P, they have 18 days in total across 17 years of I don't know how many days, but make it 365 multiplied 17, and then add a few days for the 366 days. But anyway, it's a lot of days, and so only 18 days for the Dow, the S&P and the Russell 3000, only 18 days across 17 years of VAR 99.9, so very large drawdown. And I'll tell you in a minute what, based on the time series, and the Nasdaq 100 it's 15 days. So give me a second. Okay, so a VAR, just to have a point of reference, a VAR 95 for the Dow, it's a minus 2.08%. Okay, so there is a 5% probability that the Dow will have a one-day drawdown of minus 2.08 or larger than this value. Okay, so the VAR 95 for the S&P it's minus 2.23, and the VAR 95 for the Nasdaq 100 it's for the Nasdaq 100 it's minus 2.2.5%, and the VAR 95 for the Russell 3000 is minus minus 2.27%. Okay, so these are the values for the VAR 95. So 5% probability that I have a one-day drawdown that it's larger than these parameters. Okay, then let's see the just jump straight into the VAR 99.9 just to have an idea what is the magnitude of the one-day move in the market. So okay, so the VAR 99.9, so there is the 0.1% probability that the Dow Jones in one day has a drawdown that is at the minimum minus 2.85%. So the drawdown, if the threshold is minus 2.85%, so the Dow can draw down even larger, can be minus 3, minus 4, but the threshold, the limit is this one. Once the parameter has been set, then if the sell-off is larger than minus 2.85%, then the all other market mechanisms will kick in terms of selling into high volatility and etc., and the leverage effect, because a drawdown can be magnified, can be amplified by the leverage effect that there is in the market, like funds that are leveraged and people who buy stocks on leverage and hold stocks on leverage, and also the algorithmic trading. So once certain parameters like minus 2.8% for the Dow, and the same parameter is for the S&P, also the S&P has a minus 2.85% for VAR 99.9, and while the Nasdaq 100 is a very large VAR, minus 3.77%. So there is this amount of probability, 0.1%, that the Nasdaq 100 will have a one-day drawdown of minus 3.77% or larger than this. Okay, and the Russell 3000 it's minus 3.4%. Okay, these are the VAR 99.9 parameters, at least that I have for myself, and are based on a discrete time series, or the data that start in 2007 and are up to 2024, December 2024. Okay, so once these parameters are violated, then the risk management department and also the risk management basically algorithms and all the stuff that funds are required to have to manage their exposure, it all kicks in, and then you can have people selling into high volatility, and yeah, you can have you can have leverage effect, you can have seasonality effect, and these basically tend to have amplifying and large fat tails move in markets, which are normal, are expected, but we have to start from the assumption that the Dow Jones or the S&P or the Nasdaq or any financial asset, they are not normally distributed. So when the distribution of returns are not normal, then we cannot expect to have volatility or high drawdown days or very large days of gains which are normally distributed. We have a lot of extreme values, and yeah, these are basically the outcomes of stock markets. And then yes, we have these very nice charts which are the orange shaded area. It's the 21 days rolling standard deviation band, and the blue line is the 30 days rolling, the average mean return, and the dots, yes, the dots are the VAR days violations. And again, we see that in Q4 the market has been having some VAR days between VAR 95, VAR 97, VAR 99.9, so very large drawdown days, which make me presume that Q1 there could be some kind of stock market correction. Okay, so let's see. So what I to find exactly what was what has been the pattern in Q4, so I managed to have this, you see, Q4 volatility. I narrowed down the window, the time frame, to Q4, and I said, okay, I want to see the 7 days and 21 days standard deviation. The green line is the mean return, and this is the Dow Jones, DJIA, and we had a VAR 97 here between in October, and a VAR 99.9 in December. Okay, so in the S&P we had a VAR 99 in October, a VAR 99 in November, and a VAR 99.9 in December, probably after the FOMC. This is the Nasdaq 100. So here we have a VAR 95 between October and November, a VAR 99 in November, a VAR 97.5 in November, and a VAR 99.9 in December. So these are 4 VAR days just between October and December. Okay, and the Russell 3000, yeah, VAR 95 in October, VAR 99 in November, VAR 99.9 in December. And this basically, yes, this is the summary of the VAR days only in Q4, and then I to have a clear idea, we can make the proportion of this summary for Q4 compared to the whole year. Okay, so let's have a ratio of VAR days that have happened in Q4 compared to the whole 2024 to see the ratio. So the ratio, we should see it somewhere, I don't know where. Okay, I will tell you the ratio in a second. Okay, so for the VAR 95, the ratio for the Dow is 18.75%. So 18.75% of VAR 95 has happened in Q4. And for the S&P, the ratio is 21.4%. So a little more than 20% of VAR 95 days are in Q4. And the Nasdaq, the ratio is 27.8%. So a little bit less than almost 30% of VAR 95 days are in Q4 for the Nasdaq. And for the Russell 3000 is 23.5%. So we are on average at 22% of VAR 95 days are in Q4 for these four indices, okay, which are very representative of the whole of a good part of the equity of US stocks. So I could go category for category. So the VAR 97.5, the Dow proportion is 16.6%, the S&P is 20%, the Nasdaq has a very high VAR 9.7 is 44.4%, so more than 40% of VAR 97, which are 3. So this is 44% for the whole year, and these have happened in Q4. So we see that the larger is the drawdown, and then the narrower is the time frame, which happens in Q4 in the past 3 months, right? The Russell it's 22.2%. Yes, and we can see here that the VAR 99 proportion, it's 1 day and it's 50%. So for 2024 the Dow has had only 2 days of VAR 99, which is a minus, I had the numbers here, 99. I want to repeat it again. Bear with me. Yes, minus 2.85%. So minus 2.85%. There have been 2 days in 2024, and 1 day has been in Q4. Okay, so this ratio is 50%. And for the S&P we have a 33.3% ratio of VAR 99, and for the Nasdaq is a 40% ratio, 2 days a 40% ratio, and the Russell 3000 it's a 33% ratio. Okay, but if we go to the VAR 99.9, we can see that all the indices have 1 day, but basically all the VAR 99.9, so the largest drawdown days, they've all happened in Q4. So these also are data points that would make you presume, or do invite you to search further and to understand, to work, to refine the data, and to understand if really Q4 will lead to Q1 drawdown. Okay, and I want to given that we are here, before I go into the econometric models, I'm just gonna give you my predictions. Okay, so what will be the Q1 drawdown? So, okay, so on average, the historical drawdown in Q1 for the Dow, it's minus 15.23%. Alright? And the adjusted drawdown, it's more or less minus 12.45%. So we are in the range of minus 12, minus 15% drawdown in Q1 for the Dow Jones Industrial Average. Then the historical drawdown for the S&P, it's minus, hold on your seats, 18.67%. The adjusted drawdown, it's minus 14.9%. This is the S&P, SPX, right? So we are in a range between 15 and 18% drawdown for the S&P. These are my prediction, yeah? The historical drawdown for the Nasdaq 100, buckle up, it's minus 20.45%, minus 20.5%. All right. The adjusted drawdown, it's minus 16.8%. So the NDX, it's in a range between 16, 17ish and 20%. Q1 drawdown. These are based on historical data that are collected here, 2007 to 2024. So, last but not least, the Russell 3000, which is very important. It's much overlooked, but it's very important. The historical drawdown, it's minus 16.34%. Alright? The adjusted drawdown is minus 13.12%. So we are in a range of 13 to 16%. So the Russell 3000, it's not much, it's not safer than anything else. So basically for Q1, the drawdown, it's in a range between 12 to 20% based on the indices, and if you are holding growth stocks, value stocks, but it's quite a, it goes closer to basically drawing back all the gains that have been in 2024, which is not unreasonable, and it can be a possibility. And I want to emphasize again that because the gains, there have been so large gains, investors, they don't account for the fact that can be very large losses, okay? Because the returns, the distribution is not normal. It's not a normal distribution, but these are there are a very large gain or very large losses. So there are again fat tails, and so the drawdown can be consistent, can be quite robust, okay? And this is all part of risk management for markets. So okay, testing the stationarity, and we see that the stationarity, it's okay. And then so let's start with the GARCH model results, GARCH and EGARCH model. So I had the GARCH and EGARCH exactly to trying to see what are the asymmetric conditional volatility risks that these stock market indices have in their price action. Okay, so the models, they are very consistent, and the data is very precise. So I'm very satisfied this time with the outcome. And so this is the GARCH for the Dow, and yeah, log likelihood, the model, they fit pretty well, and the coefficient, the mu coefficient, it's 0. If I'm not wrong, 67%, or I should read it better, maybe it's 0.067%, right? So basically, let me make some space. Basically, the average daily return, it's 0.067%, which is not zero. So this means that the returns, they are not symmetric, they are not normally distributed, because the average return is not zero, and the coefficient and the p-value, it's very significant, and we are in a 95% confidence interval that the daily returns are between 0.04 and 0.08 or 9%, okay, daily. So the returns are not normally distributed, because the average return is not zero, is not symmetric to zero, and so we have what? We have these extreme values which go to plus 10 and minus 10. So while the distribution, the theoretical distribution of here, these are the residuals, so the error in the conditional volatility, these are not normally distributed, but basically the chart explains that there are some large values. Okay, so we see that the coefficient is not zero, and we have some baseline volatility with the omega, and we have our alpha and beta parameter. So the alpha parameter is significant, you see the p-values, they are all very significant, and so basically past shocks of volatility, they have a 10% pass-through effect on the conditional volatility, while the beta parameter, it's 88%. So past shocks of square residual volatility have 88% persistency of volatility for the Dow Jones, and yeah, these are the confidence intervals. So we are between 87 and 88% for the beta parameter, between 9.9 and 10% for the alpha parameter. So these are very, very precise data, very precise data. And yeah, the EGARCH model is basically more or less the same, but the EGARCH model tells me that the mu parameter, it's a bit larger, it's 0.085, okay. So again, the average mean return, it's not zero, it's not symmetric, so returns are not normally distributed. And we have the alpha parameter, it's 31.9%, and the beta parameter is 95%. So we have a lot of conditional volatility due to past shocks that on the square residual that are persistent in the following price action, following trading days. And this basically also explains that help me. Yeah, it's very hard to explain. Is that the persistency tells that the volatility shock, they decay but slowly, they are persistent across time. Okay, so that's why this basically explains that if in Q4 we have seen VAR 99, VAR 9, very small probability of very large stock market volatility, then this volatility effect, past shock, they decay and then slowly, and they are persistent in the time series, and this in the stock market. Yeah, and so this will also gives another data point to say that basically Q4 volatility will carry through in Q1. Okay, and then I can make a scenario, or I can make up a narrative that in Q1 there is gonna be volatility, but I have data that can validate volatility in Q1 if happens. Okay, yeah, so these are the news impact curve. So basically 1 or 2, 3 units of shock, we see that the volatility is symmetric, and we have a 1.8% up or down based on the exogenous factors that are in the market. And yeah, we see that the residual, they are normally distributed, okay, because residuals, they are calculated to normalize the data, and then to basically to filter out all the white noise and all the variance, the error in the variance of the raw prices of the indices, basically. But we have some fat tails of plus 10, minus 10, or plus 5, minus 5%. So there are large volatility data or past events in the Dow or in the S&P or in the Nasdaq that can lead to high volatility for markets in Q1. So there's a probability that there can be a sell-off in Q1. And yeah, let's go through the S&P. We see the coefficient, it's 0.7%. The p-value is smaller than 0, so it's significant. The baseline volatility is the omega parameter, it's very small, 0.00 etc. 2-3%, so it's a very small parameter, but nevertheless there is baseline volatility. And the alpha parameter, it's 10%, same as before, and 88%. We see that they are statistically significant. These are the confidence intervals, so the alpha is in a range between 7.6 and 12%. The beta parameter is between 86 and 89%. And the theoretical quantile that show us that the residual, they are theoretically symmetric, the distribution to the theoretical quantile, but they do exhibit some very large outsized moves to the downside or to the upside. So these are all graphical things. And yeah, for the EGARCH model or the S&P, it's an alpha parameter or 31.7% and the beta parameter 95%. If we sum these up, it's if I do 0 there will be 126.76 probably, sort of. So the whole parameter is larger than 1, so it's very significant. So if I sum up alpha and beta, then I see that the past shocks of square residuals, they are significant for 95% on the beta parameter, so there is persistency of volatility, and there is correlation with past shocks of past volatility shocks. The omega, it's a negative coefficient, minus 0.45. Okay, let's go quickly forward. Yeah, we see that the news impact curve that tells us that at plastic or -3 we have a 2.2 market move, 2.2% market move, And yeah, okay, so let's see the Nasdaq, the GARCH. For the Nasdaq, they displayed all the same parameters. The GARCH model gives for the whole for the four indices, alpha parameter is 10% and the beta parameter is 88%. So there is a lot of consistency across the time series. What varies is the EGARCH, because the EGARCH model, it's able to, because it's based on the exponential distribution of returns. So basically it's able to identify more what is the asymmetry in the normal distribution, what are the very fat tails values. Okay, so we see that the alpha parameter here is 26.3%, the beta parameter is 95.66%, 95%, 0.6%, and yeah, these are the ranges. So between 21 and 31, 94 and 97%, but the p-values, they are all statistically significant. These are smaller than 0. And yeah, so there is volatility, there is persistency in past volatility shocks also for the Nasdaq, and the beta parameter is 0.95, so it's very large value, close to 1, so it's a very significant value. And yes, for exogenous news like events, that we have 2.4% market move up or down. Yeah, so the Russell 3000, yeah, the GARCH model, it's very steady, 10%, 88%, and but nevertheless we see that the EGARCH residuals and the GARCH residuals, they show some very large fat tails on the upside and downside. And the GARCH model gives more an idea what are the asymmetric volatility shocks. So the beta parameter here it's 0.95, the alpha parameter it's 0.29, the omega coefficient, so the baseline volatility is minus 0.4. So, and they are all statistically significant. So again, we have a 95% persistency of volatility for past shocks on square residuals, also in the Russell 3000, and we have an alpha parameter of 0.29. These are all very important data that can help us to understand how, when we have periods of volatility and the frequency of volatility narrows down, so large days with large moves in stock market, they happen with more frequency. These basically are designed to increase the momentum in the market for very large upside or very large downside, like a breakout, an upside breakout for the market if it's going up, or a downside break with a sharp stock market correction. So the news impact curve is at 2%, give or take, for a 3-unit shock move, plus 3 minus 3. And yeah, then we have the GARCH, the charts for the GARCH and EGARCH that they are overlaid one on the other, the Dow, the standard, the S&P. Yeah, these are clear. The blue line is the GARCH and the orange line is the EGARCH. Orange is more like a cream color, or sort of light orange. And yes, so this is another version of basically drawing what are the VAR lines. So these drawdowns, they are the VAR moments in the market. These are the value in percentages, minus 15%, minus 10%. And these are, the orange line is the volatility that picks up, and the blue line it's the return. So basically the market ends up or down a certain percentage. We see that the blue line goes down, so the average daily return throws down, and then you have at the same time that you have large VAR 99.9 we see here. So the VAR 99.9, we say that it has, for example, a threshold of minus 3.7% for the Nasdaq, this one, but the drawdown in one day can be minus 15%, right? So this is the threshold, and once the threshold it's violated, then all sorts of systematic selling in the market happens. And then you have the amplifying of the magnitude of the move, which is on the downside or on the upside. Most of the time is on the upside, but when stock market corrections are due, then they can be very, very large for a short period of time. It can be 1 day, 1 week, 1 month. Okay, bear market. I don't think we are going to have a bear market, but you never know. Yeah, this is useful to see the volatility clustering. So we see that in the last part of 2024 we had some very small, tiny volatility, but nevertheless we have these bars. They are just popping up down from the overall very contained levels, like here, the correction in 2022. And this is 2020, this is 0709, this is 2011, and these are some other market periods. So nevertheless we see that in 2024 the S&P, we have somewhat a ticking up of volatility clustering in Q3 and Q4 of 2024, of the past year. And yeah, this is very consistent for the Nasdaq, it's very volatile. And yeah, this is the Russell 3000. We see that we have some volatility in the back half of 2024. As I was saying, my starting assumption is that in the second half of 2024 the market has generated some volatility data signals, which are these clustering higher volatility values, which have gathered more frequency. And so because they are clustering, this could mean that going into 2025 we can have some higher volatility, okay, for example at this level. Yeah, so, and this again will lead to a seasonal factor and a leverage factor. A seasonal factor, which is Q1, the first 3 months of a trading year, they can lead to a short stock market correction. And we can see it here, because these are the seasonal volatility from 2007 to 2024. And we see that in January you have this value, which is 8%, 0.08, and it's 1%, and it's 1.2%. So we have a crescendo, a growth of volatility for the first 3 months of the year, which peaks in March at the end of Q1. And this is the same for all the indices that we have here. So which is the Dow, the S&P. Yeah, we see a rise in volatility trend. Remember, the trend is your friend. Nasdaq 1.4 and the Russell 3000. And then we see, for example, what is the seasonality, right? We have rising volatility in Q1, then goes down. So people go, after we have a market correction in the first 3 months, then systematic buying goes in. Asset managers, they take a look at the market and the stocks, the sector, value, growth. They start with their all blubbering, all blah 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 about this, that, the other. But nevertheless, if I give you $10, right? If John gives $10 to Peter, let's change it. If Paul gives $10 to Peter, okay? Thinking in the real world, if you have $10, Paul has $10 and gives $10 to Peter, does Peter still have $10 and he can only have $10 and nothing else than $10, or these $10 become $100 in real world, like real money, hard cash? If I have $10 cash and I give physically a $10 cash to another person, that $10 still is it can only be $10, nothing else. It cannot be $100 in the real world. But in the stock market you have the leverage effect. So $10 is 10 times, so you have $100 purchasing power to buy stocks. But the hard cash is this one. So the people, you know, they have to do the stock market propaganda and all these things. So they say, okay, buy this share, buy the other share, buy this, buy the other. But in the end, in the real world, it's, you know, $10, it's $10, and it can't be anything else. It can only be $10. It can't become $100. Unfortunately, otherwise we would have solved a lot of problems. But anyway, let's go back to seasonality. Q1, Q3 rising seasonality, then it settles down. The volatility index, like the VIX index and the S&P volatility index, it goes down. If you have a period Q2, Q3 of July, volatility goes down, so this can be a very up month. Okay, so in July you want to be long the market, but basically from April up to July you want to be long the market. Okay, and then from August you see that volatility goes to normal levels, and then in September goes up a little bit, and then in October goes to the same level that is at the end of Q1, and then it goes down because you're supposed to have the Q4 rally, the Christmas, the Santa rally. Okay, so you see that with the true data, the percentage changes of average seasonal volatility, then you can see what are the months with higher volatility, so the market is going down. The months which have steady volatility or low volatility, so the market is going up, you want to be long the market. And basically the months where the market is moving, it's going slowly down, discounting stock prices to prepare for Q4 rally. Okay, but basically the first 3 months of the year you want to be short the market, or you want to be very careful if you have a stock portfolio, ETF portfolio, which has gained a lot in the previous 12 months. Maybe you want to trim out some profit and then wait for the dust to settle, and then wait for April and then go in again. It depends from market conditions, but this is a very simple chart that explains a lot, in my opinion, in my view. And then yes, I also basically narrowed down the GARCH and EGARCH volatility for Q3 and Q4, because I want to see in a narrow time frame what is the level of volatility. Okay, this is the rolling standard deviation, and I'll go quickly to the most compelling charts, which is this one. Okay, and I think I can I can switch to the other stuff if I can, just to the charts so that are larger and nicer to see. Hold on with me 1 second. Just we were at the seasonality effects, and we have the time frame that we are considering, Q3 Q4 2024, and we see that the EGARCH and the GARCH model, they are having already some spikes in conditional volatility. So we see that the error or the past shocks of for the S&P or the Dow, they feed through the data, the market action, and then we have volatility rising in July, August 2024, and then in November and in December 2024. So we see that also with some more precise models of conditional volatility, we see that volatility has been going up. This is 1.4%, no, sorry, not 0.1, no, yeah, it's 1%, 1.4%, and yeah, more or less the rolling standard deviation has the same shape. We have high volatility in August, and then normalization, and then November and December we have a rising wave, a rising trend in volatility going into Q1. Yeah, these are very, very nice peaks and spikes of GARCH and EGARCH. This is the Russell 3000, right? So again, basically on this chart we have the blue line is the rolling volatility, the rolling standard deviation, 7 days. Green line is the 21 days. The red line and the purple line, the violet line, they are the GARCH and the EGARCH model. And then also we managed to put the dots of the VAR. So we have VAR days, and we see here we have a VAR. This is very, very interesting because the dots, they are basically parameterized to the GARCH volatility, not to the standard deviation, not only to the standard deviation, but to the conditional volatility that comes out from the GARCH and EGARCH model. So this is a very fine tool. This is a very, very refined volatility chart that basically takes the GARCH and EGARCH parameters that go through what are the residual error or what are the past shocks of square residuals, so that we can see in the residual distribution what actually are the dots, the points where we have fat tails. Okay, and yeah, here we have a EGARCH 95, and also here in August these are EGARCH 95, the Dow, and this color is a EGARCH 97.5 is this one. I'm struggling to match the colors, and this probably it's a GARCH 99 with the GARCH 95. I don't know, GARCH 99. So these are very precise. These are for nerds or for neds. Yeah, these are NEDS statistics, NEDS GARCH studies. Okay, again, S&P 500, Nasdaq 100. We have the rolling 7 days standard deviation, the rolling 21 days. This is December going into 2025. Here starts 2025. We see that we have a jump in the blue line. This is the S&P for the 7-day rolling standard deviation, and we have a jump in the GARCH and EGARCH lines, so volatility, conditional volatility, it's picking up, and it's due also to past shocks, so probably to this period. Okay, and yeah, we see that the green line, which is the 21 days rolling volatility, it's crossing the 70, the short-term volatility range, so this probably will lead to high volatility, probably, and also the blue line will turn up. Okay, here we have 2025. So in December we have a VAR 95. No, this is a VAR 99.9 also for the EGARCH model. Okay, and yeah, I don't see exactly the color, neither you, but this should be a VAR 95, let's say, EGARCH model. And yeah, here we have VAR 95 EGARCH, and this could be VAR 95 or 97.5. I'm struggling to, because the dots are very small. We have some more high volatility days here, but notice this is a VAR 99, how it's straight in line with the peak of volatility. So the VAR 99 here, also for the EGARCH, it's straight into the basically the moving average of the volatility for the model that you are implementing. Okay, and okay, let's see the Nasdaq. Yeah, here we have, this can be a VAR 99. We see the 7-day rolling moving average volatility goes up, and here we have between November and December we have 2 days of VAR 97.5 for the Nasdaq, and we have a peak in volatility. And then here between July and August we have a clustering of volatility also for the EGARCH model, and these are 3 days of EGARCH volatility, and yeah, we see the 7 days rolling average or standard deviation, so the 21 days, it goes up, right? So these are very significant, at least for me. And this, last but not least, the Russell 3000, July August rising volatility, VAR 95. This is a GARCH model, the blue dot is VAR 95 GARCH model, and here we have EGARCH VAR 95 and VAR 99, and we have a VAR 99.9 in December. Here high volatility, Russell 3000. Okay, and then I tried to do a very simple thing. So you can see here that the 21 days realized volatility in standard deviation is very much correlated with the CBOE VIX index. Yeah, this is the Dow or the S&P, and then yeah, the Nasdaq, the normalized volatility of Nasdaq with the CBOE. So of course volatility index, they are correlated with the volatility that is basically worked, is extracted from the price action. Okay, yeah, and then we have some other very interesting charts. So this blue thing is the returns of the Dow, and the green line is the EGARCH volatility. Okay, but what is most important is this: we have this line is the EGARCH threshold. So we see that we have periods with negative returns, which are clustered in 08, 09 or 2020, and these charts, they are from 1970. They start from 1970. So these charts, they are able to capture also the 2000 dot-com bubble, and we have some other volatility periods between 2000 and 2008. So this is a larger time frame, more comprehensive. But nevertheless, this line here is the VAR threshold. Okay, it's the EGARCH VAR threshold, and yeah, and we see that there is some autocorrelation and between of the squared observation of the Dow, while instead if we take the standardized residuals, the autocorrelation is none. And the quantile on quantile, yeah, they explain how we have some large -4 or -6% or -4, -6 units or observed values, like large negative values. And these are the same, they are constructed in the same way. We have a very long time series. The lines here are the GARCH and EGARCH thresholds, below which we have clustering of negative returns, and we see that we have periods of very spikes and peaks of negative returns, which are, we know when these have happened, 2020, 2008, and yeah, these are all visual methods to visualize what are the returns and what are the periods of higher returns and lower returns. And then yeah, these are more complicated things, and I'll go fast forward. Standardized residuals, yeah, okay, so then I think I'll have to switch to the model. And we go through another important thing. Okay, so basically we know that in Q4 there has been higher volatility, and we're trying to figure out if in Q1 this volatility momentum will carry through and we are going to have a correction. So I applied through the machine a stochastic volatility model and the GPD. This is a general, something that I had to learn today, generalized Pareto distribution. So basically these Pareto distributions pulls together the negative returns, and it fits the line distribution, and basically these are utilized for EVT models, which are extreme value theory volatility models. So we have a generalized volatility model, which is the GARCH model, generalized autoregressive conditional heteroscedasticity. Then if we want to pinpoint what are the probability of extreme outsize moves in the market, whether it's a correction or a large gain in markets, we can utilize this generalized Pareto distribution, or we can utilize, basically we can refer to EVT, which is extreme value, I believe it's theory. So in theory, here we have the chart of the Pareto distribution for the Dow, and then again basically we have here it went through again a GARCH model while applying a stochastic volatility method. Parameters are pretty much the same, but they are all consistent. And then yes, we have I tried to fit also an ARIMA model. So, but yeah, I have to go backwards because that was the S&P. So these are the values for the Dow. And then yes, we have an ARIMA model to see what is the autoregressive correlation. The log likelihood is a positive value, it's good. The model fits also the BIC criteria. They show that the model fits well the data. And yes, so what do we have here? So what we have here is that basically the ARIMA has been worked with the VIX and the CBOE VIX. So what happens is if I have a 1 unit change in the VIX, I have a negative coefficient correlation for the Dow, which is minus 0.038, okay, which if I can read it properly is minus 0.38%. Forgive me if I'm wrong. So basically, if just to make you understand, if there is 1 unit change in the VIX, then you have a drawdown, you have a volatility going higher, and then you have a drawdown. The average drawdown for the Dow it's minus 0.38%. So this again is a very precise measure of what to expect if the VIX goes up, how the Dow would move. And this is statistically significant, but all the parameters interpolated with the CBOE VIX, they don't have a result which is statistically significant. This cannot be considered. Okay, then yes, we have the AR and the MA model, or coefficients. So we see that we have a negative coefficient for the AR, and we have a negative minus 0.98 for the MA. So we see that the seasonality or the moving average of for the Dow in terms of autoregressive correlation, it has a negative coefficient. So past shocks, they tend to be seasonally correlated, and in the moving average or the seasonality of the moving average, we have this coefficient which is minus 0.98. It's close to 1. It's a large coefficient. And yes, for the ARIMA we have the SARIMA, which is a seasonal ARIMA with 12 months, and we have all loads of data. So for 1 unit change in the VIX, we have a negative minus 0.47% move for the Dow on the downside. So these are very useful to understand when the VIX move and volatility goes up, what is the minimum percentage move that we can expect in the Dow or the Nasdaq or the S&P. And yeah, let's go quickly. So these are the distribution of negative returns, and we see that we have fat tails. It can be minus 6, minus 10, minus 12. So we have this is made exactly to see what are the to validate the extreme value theory of very large drawdown days. And yeah, so the ARIMA model for the S&P tells me that if there is 1 unit move in the VIX goes up, of 1 unit in volatility, we have a negative coefficient which is minus 0.3% for the S&P 500. And yeah, I mean we can see also the kurtosis. It has a large value which is larger than 3, so there is leptokurtosis. So it means that there are fat tails volatility spikes in the S&P 500, and the distribution has fat tails values, although the skew of the distribution is positive 1.1. So there are more large positive values than negative values, because in aggregate the distribution is not normally distributed. The returns are not normally distributed, and but it's positive skew, and yeah, the heteroscedasticity, so basically there is some embedded conditional variance. Okay, so this is the SARIMA, so the seasonal ARIMA, seasonality is 12 months. So if the VIX moves, then we have a minus 0.23 percentage move in for the S&P 500. Let's see for the Nasdaq. The Nasdaq has a positive coefficient, so if the VIX move, if volatility goes up, then the Nasdaq goes up by 0.24%, or by 0.24%, I believe. And forgive me if I'm translating badly this coefficient value in percentage terms, transposing, but we are where we are. The kurtosis is large, and the skewness is positive, so we have fat tails data and positive skewness, although the returns are not normally distributed. Last but not least, the Russell 3000, and this is negative, so minus 0.37% when the VIX moves by 1 unit. Okay, I don't know if 1 unit is 1%, but let's take it as 1 unit. We have a negative minus 0.37% drawdown for the Russell 3000. And the seasonality effect, yeah, it's slightly small, it's minus 0.12%. Okay, so what else? Let's see. Yeah, we have Pareto distributions and other SARIMA models and forecasts. And I don't think I will okay, no, I have one more thing which is very interesting, and I'm molding you all in this journey in trying to make you understand if and when there's gonna be volatility in Q1 and what to expect. I will do a summary, a recap at the end, but then I want to show you this other method, which is a decomposition of seasonal volatility. And basically with the machine I had the decomposition of seasonal volatility for the Dow, the S&P, the Nasdaq 100, the Russell, and also for the VIX indices. And the red dots, they are basically the VAR violation that happened in Q4 according to the seasonal factors and the decomposition of the seasonal factors. Okay, so we see that the seasonal volatility for the Dow, and this is like more we have one VAR violation in basically this is parameterized for the seasonal decomposition. And then the Nasdaq has 3 red dots, so we have three let's say 3 days or VAR violations, or 3 data points I should rather say. And yeah, the Russell just 1 data point, and the S&P 1 data point. These are very difficult for me also. Well, the VIX, of course, it has more data points of VAR violations for the seasonal volatility decomposition. And yes, we have here the seasonal volatility decomposition method. So we have the observed volatility, and then we have the trend component. So we start to filter out what is the trend component, the seasonal component, which are more similar to these charts, and then the residual components. Okay, so the machine has gone through the decomposition of the seasonal volatility, and then according to the seasonal volatility we see that the red dots are the VAR days. One VAR day for the Dow, one for the S&P, and 3 days for the Nasdaq 100, and 1 day for the Russell 3000. So also a decomposition of seasonal volatility has been utilized to make more rich and insightful all the nuances of volatility for the stock market, for the Dow, the S&P, and the Nasdaq and the Russell, and so to have an idea, or to have an empirical basis to basically to prove or to theorize if we are going to have more volatility in Q1 2025. And yes, so I'll briefly repeat again what is the drawdown, what are the drawdown to expect, or maybe I have it up here. I hope you are enjoying this video, and I know it's very boring, because I'm not showing you, okay, this is the stock market, and then we should you should I don't know sell X and Y, and buy value stocks and sell growth stocks. You need to balance your portfolio, and no, it's none of all of that. What I'm explaining you is that there are seasonality effects of volatility. There are leverage effect of volatility, which are embedded in markets. And okay, great. And these have to be accounted for, and these data points have to be factored in the risk management for asset manager. I struggle to believe that you are checking by any measure of volatility, unless it's the VIX index. So let's say this is a study of what is the intrinsic volatility of the Nasdaq, the S&P 500, the Dow, and the Russell 3000, and the volatility is intrinsic of the index, of the indices, of the price action. And so when we find that we have volatility clustering events in Q4, and this volatility basically represents 20 to 40% of all volatility in 2024, then we can bring forward these data points and analyze these data points through implementing various methods of volatility study, which can be GARCH and EGARCH model, and then the decomposition of seasonal volatility. Then we can try to find what are the extreme volatility values, which can be -2%, -3%. This is done with the VAR value at risk models, and also with the Pareto distribution of extreme values. So we can do a lot of work and take a lot of data with us, and so to build an idea and have an idea what to expect in Q1 and what is the volatility in Q1. So okay, I think that I will take the easiest charts for you all and for me as well, because this is very complicated and cumbersome to go through. Okay, so we are talking about seasonal volatility, and here we have the months, and we see that seasonal volatility picks up in January, it peaks in Q1, and then we are steady. So we are short Q1, we are long Q2 going into July and August, and then we want to rebalance our exposure between September and December. Okay, and then rebalancing a portfolio, this is a whole other thing that I'm not going to go through today because it's not of my personal interest. So okay, what to expect in Q1? Okay, last and definitive prediction forecast for Q1. Okay, the Dow can have a minus 15.2%, and adjusted drawdown is minus 12.4% in Q1 2025. Okay, the S&P 500, it's on an historical basis is minus 18.67%. On an adjusted basis is minus 14.9%. So we have a range of 19% drawdown for the S&P 500. The Nasdaq, on an historical basis in Q1, we have minus 20.4%, and on an adjusted basis we have minus 16.8%. So we are in a range of minus 20, minus 16.8. Okay, for the Nasdaq in Q1. So if we have a minus 20% in Q1, or even a minus 16%, it's a healthy, sizable stock market correction that basically brings through then value investing opportunities. So it's not something that I would see as a bad thing, because the markets are very pricey and expensive. So if there is a correction, it's good, because the market goes down and then you can start and build up the portfolio again. You basically take profit in the first 3 months and then go at it again in the following quarters, and it should be, if it's done properly, it's good. If you hold, it's your problem. Russell 3000 Q1 correction is minus, on an historical basis, minus 16.3%. On an adjusted basis is minus 13.1%. So we are in a range of minus 16 to minus 13%. So these are the prediction. Okay, minus 15 the Dow, minus 15 to minus 18 the S&P, and minus 16 to minus 18 the Nasdaq, which is the more volatile with the largest drawdown, minus 13 to minus 16% the Russell 3000, and we visualize it here. This is the forecast that comes out from this website. So a 400 points shaving for the S&P 500, and yes, I hope you enjoyed. It has been very long and very a lot of work, very hard to do this video. I hope you enjoyed. I hope I gave you a lot of data points, and I hope you appreciated my hard work in these days to find these nuances and to give you a best-in-class demonstration or idea of what has been volatility in Q4 and what to carry through in Q1, so that you are not unprepared to when a stock market drawdowns happens. And let's see what will bring us Q1, if the seasonality and the leverage effect will take place in markets, so we will have a correction and then a buying opportunity. For this I will have to love you and leave you. Please, if you can, leave a like on thumbs up for this video, and if you want to comment, you're very welcome, and see you soon. Take care.